Talk about that headline that everybody saw. The Dow finally pushed above 50,000, and it didn't creep over it either. It jumped on Friday. It was a sharp bounce after a rough stretch, the kind of move that makes people go from doom scrolling to chest puffing in about 10 minutes. Roughly 2.5% in one session, about 1,200 points. And just like that, a psychological ceiling turned into a talking point. Now, I also want to address the nostalgia trap that comes with a milestone like this, because every time the Dow prints a new big round number, people start digging up old predictions. You remember the vibe. The Dow is going here, the Dow is going there. This is the new era, and it's entertaining, but it can also mess with your decision M. There was a famous wave of bullish writing back in the early 2000s that basically argued the Dow was wildly undervalued and that a huge upside target was right around the corner. Not someday, but soon. And what actually happened is the market eventually got there, but it took a lot longer and it took a very ugly road in between. That's not me being negative, that's me being practical. If you're the type of person who reads a bold forecast and then buys at the moment everyone is celebrating, you're basically volunteering to buy the top of a hype cycle. And if you're the type of person who reads a scary headline and sells the moment everyone is panicking, you're basically volunteering to sell the bottom of a fear cycle. So the way I look at 50,000 is not as a target. It's a mirror. It's reflecting how far sentiment has stretched. And the only question that matters is whether the fundamentals and liquidity can keep up with that stretch. And the reason I'm saying this is because the Dow didn't reach this number by accident. It reached it because a handful of mega app names are still doing most of the heavy lifting. And when those names are green, the indexes look bulletproof. But here's the question I want you to sit with for a second. Was that move a sign of strength, or was it a release valve? Because those are not the same thing. Strength is a trend that keeps showing up even when nobody's clapping. A release valve is what happens when positioning gets too lopsided and the market snaps back just to breathe. And you can actually see that tension when you zoom out and look at what happened today, Monday. The Dow held the big number, but it didn't lead. The Nasdaq did. The broad index did. Tech was the engine again, while the Dow basically tiptoed to another record close. That's not bearish by itself, but it's a clue. It's telling you the market is still being carried by a narrow set of names and themes, not by a wide, healthy surge across everything. Let me give you a quick snapshot of what that looked like today without turning this into a laundry list. A couple of large software and platform names popped hard on upgrades and headline relief, which helped the broad index and the Nasdaq look healthier than the Dow's tiny move would suggest. At the same time, even within the so-called mega cap club, it wasn't a clean sweep. Some of those giants were higher, but a couple were actually red, which tells you the market is still picking its spots instead of buying everything blindly. And that's why I keep coming back to the basket view. If you track the big 7 megap growth names as one trade, you can feel how different this market is from a true broad-based bull run. When that basket is rising, it can make everything feel safe because it pulls retirement accounts higher and it keeps the headlines upbeat. But when that basket is choppy, the rest of the market starts to feel like it's walking on a cracked sidewalk. Now, here's a nuance most people miss. A basket can be near the lower end of its recent range and still be in a bull market. It doesn't have to be collapsing to be dangerous. Sometimes the danger is simply that the market has become one trade and that one trade stops trending. So if you've been riding that wave, I'm not telling you to panic. I'm telling you to respect the possibility that leadership can rotate away from the biggest names. And if that happens, the indexes can look fine while your portfolio feels like it got hit by a truck. And while we're here, let's talk about Tesla for a second, because it's the perfect example of how headlines and price action can disagree. Tesla can be up on the day and still be sitting right on top of a support zone that, if it breaks, changes the whole picture. That doesn't mean it will break. It just means it's one of those charts where you don't want to pretend you can't see the line in the sand. Now, When you combine that kind of chart fragility with a Dow at 50,000, you start to understand why I'm not in the everything is awesome camp, even though the tape is green. Now, the fun part is everybody wants to attach a story to that. It's the new economy, it's the AI wave, it's rate cuts coming, and sure, those stories can be partly true, but the market rarely gives you just one clean reason. It's more like a messy cocktail. So let's break down that cocktail in a way that actually helps you. Because if you're trying to build wealth, you don't get paid for having opinions. You get paid for seeing the setup early and managing your risk when the setup changes. First ingredient, the rebound trade. After several ugly sessions, a lot of short-term money was leaning one way. When it doesn't keep working, people cover, they chase, and suddenly the tape looks like a miracle. We've all seen it. Second ingredient, headline leadership. One or two heavyweights can drag an index the way a big truck drags a small trailer. You don't need the whole market to rally. You just need the biggest weights to stop falling and start rising. And on Friday, that's exactly what happened, led by a couple of the usual suspects that can move entire indexes when they catch a bid. Third ingredient, the maybe the Fed flinches trade. You can feel it in the way traders talk. You can feel it in the way yields move. And you can absolutely feel it in the way gold and silver refuse to stay down. And I'll get to the metals in a minute because that's where the story gets spicy. But before we go there, I want to talk about the stock internals for a second because they explain why this move looks strong on the surface and yet still feels fragile underneath. On the winner's side, you had a lot of the same energy. Chips, cloud, the big data names, the stuff that's become the market's comfort food. And on Monday, you saw that again with tech leading, and even the information technology slice of the broad market sitting at the top of the leaderboard. On the loser side, it's not that everything is collapsing, it's that the weak spots are still the same weak spots. A big retailer can miss, a mega cap can guide lower, and suddenly one stock can look like it got pushed off a cliff. That's not new. What's new is how fast the market is rotating from I love this to I can't own this with almost no warning. So here's my first comment question for you. Do you think the Dow above 50,000 is a celebration moment or a warning sign that prices have floated too far from reality? I want to hear how you're thinking about it. And if you want a quick reality check on how jumpy risk appetite still is, look at crypto. Bitcoin can go from calm to chaos in a heartbeat, and last Friday was a perfect example. It dropped hard, then snapped back, and by Monday, it was basically acting like nothing happened. That kind of move is not the behavior of a sleepy, stable market. It's the behavior of a market where liquidity is abundant, but confidence is thin. So price can swing fast when positioning gets crowded. I bring that up because the same psychology shows up everywhere right now in high-growth stocks, in silver, and even in the dollar. People are trading narratives at high speed, not building long-term positions at low speed. Now, let's pivot to currencies, because this is the backdrop that quietly shapes everything else. The US dollar has been slipping, and a lot of people treat that like a scorecard. Dollar down equals risk, on equals stocks up. Sometimes that's true, but sometimes it's a symptom of something deeper, which is that confidence is moving from hold cash to hold anything else. And when that starts to happen, it shows up in odd places first. One of those places is the dollar index, and recently, it's been sitting in the mid-90s and sliding on days when you'd expect it to catch a bid. On Monday, it was down close to 1% even as stocks were green and volatility was still in the air. Now, you can also look at the dollar against a safer currency and tell a similar story. Over long stretches, the dollar has had trouble holding ground against currencies that the world views as boring, stable, and disciplined. And before somebody jumps in and says, yeah, but every currency gets printed, you're not wrong. It's not about perfection. It's about relative trust. It's about who looks like they're playing the cleanest game in a dirty league. And here's where I'm going to challenge a common narrative. A lot of people talk about dollar weakness like it automatically means the US is falling apart. I don't buy that as a blanket statement. The US can have a soft dollar and still be the place global money runs to when fear spikes. We've seen that pattern again and again. So the real question isn't, is the dollar weak? The real question is, when fear hits, does the dollar still get the first phone call? Because if it doesn't, that's when the whole chessboard changes. And that takes us straight into metals. Gold has been acting like it has somewhere to be. Even after violent pullbacks, it keeps finding buyers, and it keeps returning to that 5,000 zone like it's a magnet. On Monday, gold futures were up strongly, still well below the late January peak, but very clearly not behaving like an asset that's finished. Now, here's the part people miss. It's not just gold, it's silver. And silver has been even more emotional than gold, which is saying something. Silver can go from hero to villain in a single session and then right back again on Monday. Silver futures surged, but even that surge was still a bounce off a much higher peak set late in January. And I also want to say something about silver that has nothing to do with vault charts, because silver is not just a monetary story. Silver is an industrial story. It's in electronics, it's in medical equipment, it's in solar panels, and it's in the wiring that makes modern life run. Over the last few years, demand from electrification themes has been trending higher. And even when the economy slows, those industries don't just shut off overnight. They slow, they adjust, they substitute where they can. But silver has a habit of staying on the shopping list. That's why silver doesn't behave like a calm store of value the way people imagine gold does. It behaves like a hybrid. It can trade like a risk asset when growth is the story, and then it can trade like a monetary hedge when currency confidence is the story. And when both stories hit at the same time, you get those explosive emotional moves that we've been seeing. So if you're trying to understand silver, don't pick one narrative and marry it. Treat it like a complicated animal. It bites when you get cocky, and it rewards you when you respect its nature. So if you're watching this and thinking, okay, Clear's throat metals are up, that's all I need to know. Slow down, because the why matters here. And the why has two lanes: paper trading and physical demand. Those two lanes usually travel together, but when they separate, you get clues you can't get from a chart alone. And that brings us to the detail that keeps coming up in my comments: the overseas premium. There have been stretches where physical silver outside the US is traded at a noticeable premium to the US benchmark price, especially in Asia. And when that premium widens, it's basically the market telling you the metal in hand is being treated differently than the metal on a screen. That doesn't guarantee anything dramatic happens next, but it's not nothing either. And one reason that overseas premium conversation has been getting louder is because the Asia side exchanges have been dealing with their own version of the frenzy. Recently, Chinese metals exchanges have repeatedly tightened rules and raised margins to cool things down, not just for gold and silver, but across the whole metals complex. When an exchange is stepping in over and over, it's basically admitting the crowd is pushing too hard too fast. That doesn't tell you where price ends up, but it does tell you the demand to participate is intense. Now, let's talk about the place where the paper lane and the physical lane collide: the exchange vault data. This is where people get emotional. So let's keep it grounded. On the exchange, silver inventory gets split into buckets, and one bucket matters more than the others when it comes to delivery. The deliverable bucket has been hovering a little above 100 million ounces lately. The bigger bucket, the eligible category, is much larger, closer to 300 million ounces, but that doesn't mean it's available. It just means it meets the specs and it's sitting in approved storage. Now, the temptation is to look at that deliverable number and immediately yell shortage. But that's not how this works. The deliverable bucket can rise or fall for reasons that have nothing to do with the total metal disappearing. Sometimes it falls because owners prefer to keep metal in eligible form until someone pays them enough to make it worth converting. Sometimes it rises because a holder sees an opportunity and moves metal into deliverable status. So you can't treat the deliverable line like the fuel gauge in your car. It's more like a seating chart at a packed arena. The building can be full of seats, but not every seat is for sale at the same price, and not every holder wants to move. Today, that said, incentives have been shifting, and that's why this matters. Now, when volatility explodes and the market starts paying a higher price for immediacy, the motivation to keep metal off limits can weaken, but it doesn't weaken evenly. It weakens in bursts, and those bursts are exactly what create the scary days. The days where the market feels like it's running out, even though total stocks still look large. So when you see headlines like "the vaults are empty," don't fall for the clickbait. Total inventory is still huge in absolute terms, but the deliverable portion is the one that can matter during a delivery window. And that portion has been drifting lower while attention on silver has been exploding. And here's where it gets interesting, because even the exchange itself has been responding to the speed of this move. Margins on precious metals futures have been raised again as volatility has whipped prices around. That's basically the exchange saying, "We want more collateral because this is getting rowdy." And when margins rise, you often get forced selling, which can create sudden drops that look like the trend has died, even when the underlying demand hasn't changed. Now, here's the twist. On this exact day, the exchange is also rolling out a smaller silver futures contract designed to meet surging retail demand. That's a big signal about what kind of participation they're seeing. It means interest isn't only coming from large institutions hedging industrial flows. There's also a crowd element, and crowd elements can make price action way more violent in both directions. So, what does that mean for the next few weeks? It means the market can do two opposite things, and both would make sense. Scenario 1, the paper pressure calms down. A lot of open positions get closed, rolled, or settled without metal moving. That's normal. That's how futures markets usually work. And if that happens, the scary math that people post on social media starts to look a lot less scary. Scenario 2, enough participants decide they actually want metal, or they decide they want to stress the system. And the deliverable bucket keeps shrinking right into the notice period for the March contract. And if you have a lot of paper still open, while the deliverable stock is sliding, even if only a slice of those holders stand for delivery, the optics alone can create panic. And I'm going to be honest with you, I don't think the base case is some clean default headline. Exchanges have playbooks. Big players have relationships. Cash settlement exists. There are mechanisms. The market has more escape hatches than people like to admit. But that's not the same as saying there's no stress. Stress shows up as higher premiums. Stress shows up as faster inventory moves. Stress shows up as margin hikes. Stress shows up as people talking about silver at the dinner table again. And we're seeing all of that now. Now, the March timeline is what keeps coming up because the notice period starts late in February. That window matters because it's when you find out how much of the paper turns into real demand for bars. And between now and then, you're going to see a lot of gamesmanship. You're going to see big open interest numbers drop quickly as traders roll forward. You're going to see sudden dips that scare out late buyers. You're going to see sudden spikes that bait in FOMO buyers. And you're going to see nonstop posts about "this is it." So here's my second comment question. Do you think the physical premium overseas is a real signal of tightness? Or do you think it's mostly a temporary logistics and sentiment story that fades once volatility cools? Now, another clue that gets ignored is the delivery pace we've already seen in recent months. Normally, the early part of the year is not when you'd expect fireworks and physical deliveries. It's usually quieter because a lot of industrial flows are hedged on longer schedules, and a lot of speculative money is waiting for the spring. But lately, the delivery numbers have been punching above their weight. January saw an unusually large chunk of contracts actually turn into delivered metal. And February started out with a pace that would be considered aggressive even in a busy month. Again, I'm not saying panic, I'm saying pay attention. When deliveries are small, open interest can look huge and it can still be harmless. But when deliveries are already running hot and then you look at a March contract that still has a very large amount of paper exposure open, you start to realize why so many people are watching the late February notice window like it's a countdown clock. And this is where the psychology gets dangerous, because the moment the crowd believes a squeeze is inevitable, the crowd starts behaving in a way that tries to force the squeeze. That can inflate premiums, tighten availability in the short run, and make the story self-fulfilling for a while, even if the market eventually cools. So, you want to be careful not to become a pawn in someone else's game. If you're buying physical, buy because you actually want the metal. If you're trading paper, trade because you have a plan and risk controls, not because you're hoping a headline bails you out. Now, while everybody fixates on silver, don't ignore what's happening in the broader macro because it's feeding this whole story. Bond yields have been sliding a bit, which is one reason growth stocks caught a bid. But the bigger reason is the market is trying to front or run the next policy turn on Monday. The 10-year yield was hovering a little above 4%, and policy expectations right now are messy. On one hand, some data is still telling you inflation isn't conquered and growth is still hanging in there. On the other hand, there are fresh signs of stress under the surface. Layoff announcements have picked up, and even basic economic reporting has gotten complicated because of disruptions that are delaying key releases. That kind of uncertainty tends to push traders toward the Fed will eventually have to respond, even if the Fed doesn't want to. So when you look at rate probabilities for the meeting that ends in mid-March, the market is still leaning toward no change. But the odds of a cut have been bouncing around and can jump fast on any new headline. And that's why you're seeing this strange combination. Stocks making new highs, the dollar slipping, and metals refusing to quit. Now, let's bring it all together because this is where most people get confused. They see the Dow above 50,000 and they assume that means everything is fine. They see gold above 5,000 and they assume that means everything is broken. And the truth is, both can be true in the same week because markets are not one story. Markets are a bunch of stories fighting each other. And one last piece of context because it helps you keep your head on straight. When indexes print new highs at the same time cash feels weaker, you're often watching two sides of the same coin. Asset prices can rise because businesses are genuinely growing, but they can also rise because the measuring stick is shrinking. So I watch not just price, but spreads, credit, and real-world stress signals. If those stay calm, rallies can last longer than anyone expects. If they crack, the headline highs become traps. Stay alert and patient. Here's the story I think matters most right now. The stock market is still levitating on liquidity, buybacks, and a belief that the future will be dominated by a handful of companies that can grow no matter what. That belief might be right over a long horizon. But in the short run, it creates fragility because if just one of those pillars cracks, the whole index can wobble. At the same time, the metal market is behaving like a pressure gauge. It's not predicting the end of the world. It's reflecting that people are uneasy about the long-run purchasing power of money and the stability of policy. And the more policy looks political, uncertain, or reactive, the more that pressure gauge tends to rise. Now, if you're watching this and you're already positioned, here's what I want you to do. First, stop anchoring to a single price. Anchor to your plan. If you bought stocks for long-term compounding, great. If you bought metals as insurance, great. But don't let one violent session convince you that your plan was stupid. Volatility is the price of admission. Second, think in terms of ranges, not certainties. If the Dow can jump 2.5% in a day, it can also drop 2.5% in a day. If silver can rip higher in one session, it can also slap you down in the next. So don't size your positions like the market owes you kindness. Third, Be honest about what you don't know. None of us knows exactly how many contracts will stand for delivery, or how quickly open interest will roll away, or whether a premium overseas widens again next week. That uncertainty is why you manage risk. And fourth, watch the clues, not the noise. Watch deliverable inventory trends. Watch whether premiums stay elevated. Watch whether margin hikes keep coming. Watch whether the dollar keeps sliding even when fear pops up. And watch whether tech leadership remains narrow or starts to broaden out. Because if leadership broadens, that's a different market. And if leadership breaks, that's also a different market. Now, one more thing before we wrap up, and I want to say this directly because it matters. What matters is what happens after the applause fades. If you found this useful, subscribe so you don't miss the next update, and leave a comment with your take on where you think the real risk is right now. In overvalued stocks, in a softening dollar, or in the plumbing of the metals market. As always, this is for educational purposes only. I'm sharing how I'm thinking about the market, not telling you what to buy or sell. Do your own research, consider your own situation, and if you need personalized advice, talk to a qualified professional before making any financial decision.